Hi, welcome. Thank you for making it here today. I'm Ashley Murphy, the founder and principal of Arete Wealth Strategists Australia, an SEC registered investment advisory firm helping Australians in America and Americans in Australia. Today's presentation will be on navigating the One Big Beautiful Bill, recently passed tax legislation that largely extends the 2017 Tax Cuts and Jobs Act. And I'll be unpacking what this means for Australians in America and Americans in Australia. Of course, always worth noting that today's presentation does not constitute personal financial advice. If I am your financial advisor, then of course that is something that we would engage in. But if you're merely attending today's presentation, then that would not be a topic or an expectation that you should have. Okay, our YouTube channel, I should mention, if you're interested in these topics, please feel free. I should note we did my wife and I did our sixth installment of our series, Living Between Two Countries. That was last month. You can go there and subscribe if that is of interest to you. A little bit about me. I am a tri-citizen, really born into this cross-border financial world. Mother was American, dad is Australian, born in the UK, educated and grew up in Australia, moved to the US 2005, lived there for 20 years, became a financial planner, got a graduate degree in Australian financial planning, and I'm a US CFP, co-founded the Global Financial Planning Institute, where we train and run conferences for fiduciary financial advisors, helping those advisors with clients whose financial lives cross borders. Areté Wealth Strategists, this is the kinds of clients that we work with, the sorts of goals that these folks come to us with, and the sorts of results we've achieved. So with all of that said, let's get to today's presentation. So I'll be going through and talking very briefly about and summarizing the bill at a very high level. So it's really an extension of the Tax Cuts and Jobs Act, an extension for QBI, for qualified business income, and mortgage interest. So that's the first slide. Next, going into the SALT changes, which is an extension from $10,000 to $40,000 for certain income brackets. Going into some detail about this so-called no tax on Social Security, what it really means for seniors. That's a good point right there for me to reiterate what I said. We've just been a number of people that have joined in the last few moments, but today's presentation is not a detailed summary of every single provision within the One Big Beautiful Bill. It's really focusing on those things most relevant to my client base and prospective client base. So things like taxes or sorry, no tax on tips. I'm not talking about that. I don't have any clients or nor have I had that are in that particular situation. Next, I'll be going on to the remittance tax. A lot of interest in that. That's certainly something that's piqued the interest for Australian expats. Next, looking at the estate tax limit and how that's been permanently extended. And then last will just be to address a change that occurred at the last minute to do with retaliatory international tax provisions. I should say I like to offer it as a treat for those that attend live. You're welcome to chime in with your chats as things go. So if you have a question, and ideally it's something that I haven't already addressed, or if it's not upcoming, then I will take a moment to do my best and address that for you. Here we go. Okay. So as I've mentioned twice already, the One Big Beautiful Act really extends the first Trump term Tax Cuts and Jobs Act of 2017. So what did that act do? That act changed tax brackets. It eliminated the personal exemption. It doubled actually the standard deduction, and it made some changes it introduced this concept of Section 199A, qualified business income, and it changed mortgage interest. Until that time, it was possible to deduct all of your mortgage interest, whereas now there's a cap that's gone in place. So just looking here on the top left, so the individual tax brackets, I am going to pause screen sharing for just a moment and share with you a new resource that we shall publish. So Currently, it's just called important numbers, but what we have here is a key financial data sheet that includes many of the tax changes that have happened because of the One Big Beautiful Bill. So that's something following today's presentation I will get up on the website. I will also endeavor to send that out in the email following today's presentation, just to thank you for attending. So as I mentioned, it's made permanent the changes to the individual tax brackets. So we now have an upper limit of 37% for higher income earners. The standard deduction has doubled. Next year, it'll be $16,000. Or excuse me, for 2025, it'll be $16,000 and double that for married filing joint. And a repeal of personal exemptions, as I mentioned earlier. Qualified business income, if you're a business owner and you are not subject to what's called a specified service trade or business, then this is a beautiful tax reducing mechanism for you. And there are some thresholds that apply. So what the One Big Beautiful Bill has done is to extend the phase out threshold. So it used to be that the thresholds, forgive me, because I'm going to guess here these numbers, it was about 500, it was in the low 500,000s, where if you made above that and you had a specified service trade or business, typically these are professional services firms amongst others. But if you had a professional services firm, be it a lawyer, an accountant, and heavens forbid, a financial advisor, then you were deemed to be a specified service trade or business and subject to this phase out. If, however, you are manufacturing widgets in the United States, which is exactly what they want to incentivize, then you did not have an upper limit. And so this 20% deduction could be something you could take advantage of. So what's happened here with the One Big Beautiful Act, One Big Beautiful Bill, as it's called at least, is the extension of this limit. So it's gone up by some amount for those that are subject to the phase out. So very, very specific thing right there. Another change that's been made permanent, again, was already present in the TCJA, was mortgage interest limit, $750,000 of mortgage indebtedness. So what does that mean? You go and buy a lovely home in Palo Alto, maybe it costs you $3 million. You take a mortgage of $2 million. Unfortunately, only $750,000 of that mortgage are you able to deduct interest from on your tax return. So given the dramatic increase in the size of the standard deduction, you've got to be able to itemize and come up with $32,000, assuming you're a married filing joint tax filer in the first place, before you could take advantage of that anyway. So with interest rates as high as they are right now, if someone did in fact have a mortgage of that amount, then it probably would be worthwhile and would be deductible. So that's worth mentioning. Mortgages originating before the December 15th, 2017 are grandfathered in and retain $1 million cap. Home equity interest is still disallowed unless it's used to substantially improve the home. So if you take a HELOC and you use that to take a Disney cruise, then unfortunately that's not going to be deductible. But if it's used to renovate and improve the home, then that would be deductible. So what we've seen here is an extension of the tax brackets, a change in the standard deduction, a change to the phase out for the specified service trade or business relating to QBI, and then the making permanent of the mortgage interest changes. Next, changes to state and local tax deductions. This could be very interesting indeed for property owners in California, New York, or in other expensive parts of the country. So, but all that glitters isn't gold, because it is subject to a phase out, as many of these items are. So the SALT, SALT, of course, state and local tax deduction, was limited to $10,000 previously as per TCJA. What's happened now, however, is that's been increased to $40,000, but subject to a modified adjusted gross income upper limit of $500,000. So it was put very well in a podcast I was listening to by the AI CPA, where they said, in fact, your marginal rate between $500,000 and $600,000, where the SALT limit moves from 40 back down to 10, it could be if you were in a position where you were contemplating taking a job and they were going to pay you $600,000 to work full time, or maybe just for 4 days a week or 3.5 days a week, they were going to pay you something around $500,000 or slightly less. You might find that to take that 1 day a week less work for less money, in fact, could be a much better hourly rate, given the effect that it has, and that you're losing $30,000 of state and local tax deductions. So that's what's changing here. So above $500,000, 500 to 600,000, it is going away back, or it's diminishing back to $10,000. This is not going to see an annual CPI adjustment that follows inflation, which has been all too high in the past couple of years. Instead, it's going to increase at 1%. So the sweet spot, if I were to summarize who's going to benefit most from what we saw on the first slide and the second slide, it would be a business owner making around $500,000. That's going to be the sweet spot where you're able to enjoy this higher standard deduction. If you aren't able to itemize, you're going to get 20% off of your QBI income. Maybe you've got a mortgage, you could deduct $750,000 of interest, or interest on the $750,000. And you'd also be able to enjoy a $40,000 state and local tax deduction. Next, no tax on Social Security. What was this all about? Well, Truth in Advertising, or one of these shows like Media Watch, would probably have a field day with this claim, because it's not exactly as it claims, but the effect in the end is about the same. So it doesn't repeal Social Security taxation. Instead, what it's doing is providing an additional $6,000 deduction for those over the age of 65. Again, there is a phase out. You see here, you get above $75,000 as a single filer, or $150,000 as a married filing joint, and that begins to go away. So it's really targeting, yet again, the mass affluent folks that are retiring. So this is a standard deduction boost, not a change in the tax formula. Why is that? Because changing Social Security is a very fraught political undertaking. And so this was found to be a simpler way to do it. But do note, I do want to draw attention for some of the more keenly eyed observers of today's presentation. And that is, what are those things that have been made permanent, and what are those things that have a temporary nature to them that will expire at some point? This is another one of these sweeteners that will expire. So come 2029, this $6,000 goes away. So it's a bit of a ticking time bomb politically for the next administration, and who knows, if this may also be made permanent. We'll see. There's consideration that needs to be given to the deficit and the indebtedness of the U.S. the U.S. itself. Most concerningly, over the past dozen years, we've seen two of the major credit rating agencies downgrade the U.S. government from its AAA rating. So the economic historians suggest that this downgrade and the debt and the amount of spending that the interest is now occupying in the budget, which is soon to exceed the military budget, is a very concerning trend that's underway. Okay, so regular standard deduction for single folks is $15,750, $31,500 for joint in 2025. Then for those over 65, they get a $2,000 for single filers, $3,200 for joint if both spouses qualify, and this is what we see here. So here's the summary of this. Here's the base standard deduction, throw in another two that was already there for those over 65. and then slap on another 6,000 or 12,000, and you're seeing some pretty significant standard deductions in place. That is really going to limit, for folks over the age of 65, a standard deduction of 46,700 is really going to limit the number of folks that would itemize, unless they had significant charitable intent, because charitable donations are deductible, we shouldn't forget. There's not going to be a huge tax burden for folks, at least in these income brackets, until the end of 2028. Let's move on. The 1% remittance tax. By the way, it's been remarkably quiet, I should mention, on the chat front. I think people are either mesmerized by what I'm saying, or I'm doing such a wonderful job in clearly explaining these points that there's no other questions coming up. The 1% remittance tax. Now, this one had me on the edge of my seat, because not only could it affect my clients, it could affect me. Didn't end up happening as it occurs. So this, as the final bill took effect, it only affects cash-based remittances. So let's be specific about that. We're talking about Western Union, MoneyGram, PayPal, that kind of thing. We do not recommend clients use those sorts of services. We actually we've negotiated an institutional rate with a company called Currencies Direct, which is half, by the way. Everyone always says, oh, well, I use TransferWise or OFX. Well, we actually get a rate that's half of what they charge, so it's an even better deal. If money is sent, as we see, where do we see? Transfers facilitated by banks, credit unions. Okay, it does not apply to, so that's what I was looking for. Transfers funded directly from accounts at financial institutions. That is most US bank accounts. All right, so that is not applicable. Transfers funded by US issued debit or credit cards. Electronic transfers outside the above categories. So who is this largely impacting? It is impacting folks that are, for better or worse, it's impacting people that are sending remittances back, the unbanked, if you will, that are using Western Union, MoneyGram, or PayPal, those kinds of services. All right, now the chats are rolling in. So WISE and OFX are exempt, asks Kay. Fine question. I do want to double check that, though, because that is a very good point. The generic, what, it's a tough one, because Wise does in fact have I believe they have a banking license. At least they offer a card. So I wonder if that gets them out of it. As for OFX, I'm going to have to double check on that. So I don't want to say something that turns out to be wrong. I will contact them explicitly and hear what they have to say. Daniel Flynn, would it apply to transfer wires from bank to another bank? Same question as what Kay's asking. Is this Australia to US only? No, it's the other way around. It's US to Australia. Ron's said OFX is wire bank to bank. I use OFX. So Ron, maybe you could clarify, does it apply or not apply? Christine writes, so if I have a US bank account and wire transfer money to my Australian bank account, I will get hit with a tax or not? Well, no, that's, Christine, does not apply to transfers funded directly from accounts of financial institutions. So that one we can be very clear on. Robert, good to see you here. Slightly unrelated, but did deliver on the campaign promise to stop taxing US citizens. No, that actually was never part of the One Big Beautiful Bill, as far as I'm aware. That relates to, that is a great
Hello, everyone.
Cause that I support, but let me show you that actually relates to what we're talking about here, the residence-based taxation for Americans abroad. So that is a completely different bill. I never heard that it was part of the One Big Beautiful Bill, but this is something we all want to do our darndest to support and get in place, because many of the discriminatory provisions that apply to Americans abroad that do not apply to other Western developed countries and their citizens abroad would be repealed if this went into effect. Let me go back to the presentation. And we'll continue on right now. Okay. So John's happy to hear that, and Robert said, "Bummer." Well, that's right. It is a bummer. So the 1% remittance. The conclusion from this is I will need to check whether OFX or TransferWise will be subject to this. Uh, but generally speaking, it's exempt if you're talking about from one bank account to another. Yes, Apana, this is the tax on US to Australian transfers. Whether that apply, I think if we went to TransferWise, or we could answer this very quickly. Next, estate tax limit permanently extended. So the Tax Cuts and Jobs Act raised it from, it was about 5 million back in 2016. It then went to, I believe, was it 11 million, and it's picked up by inflation ever since. So nearly 14 million in 2025, set to go to 15 million next year. That's per person, remember? So if you're a married couple, you're talking about $30 million. It doesn't eliminate some trust planning that one would need to do if you had a net worth in excess of that. But nevertheless, it is a very high limit. And some wealthier folks will be pleased to see that I don't have to worry about the 40%, excuse me, rate that applies when you have an estate in excess of that. Some more chats have come in. Daniel Flynn asks, IRS treatment of Aussie super accounts really needs to be addressed. Absolutely. Unfortunately, that was not part of the One Big Beautiful Bill. I have done webinars on that previously, Daniel. Probably a good reminder for me to do a refresher on that. Broadly speaking, one superannuation account will either be deemed as an employee benefits trust and not taxed during the accumulation phase, but is taxable during the distribution phase. Conversely, if it is treated as a foreign grant or trust, then that is going to be taxed presently on a mark-to-market basis from one year to the next. But the good news is that then you've established a basis in the superannuation account and likely would have a much lower, if any, US tax owing at the time of distribution. And then Daniel writes, estate tax limits apply to green card holders too, or only citizens. What a fine question. This is an obscure point of reference. It actually applies to anyone who is domiciled in the US. So as crazy as that sounds, if one didn't have all of their papers, but had taken actions that indicated that you planned on staying in the US permanently, that is your domiciliary intention. So it actually doesn't matter. It could be a temporary visa holder, could be of course, a citizen is most likely to be caught up in that, and a permanent resident, just by virtue of the name, a permanent resident suggests something about your intention. So there's some trivia knowledge for you in case you're wondering. The legal status doesn't matter. It's your domiciliary intention. Okay, and then lastly here, what I have for you is the retaliatory international tax regime. So this was lifted. Let's just say that first and foremost, no retaliatory tax in the final law, yet the risk remains. So there was some pretty hard lobbying that was done to remove this. The idea being that it got very complicated. It might have affected investment, foreign investment, and there's plenty of that goes into the US because it introduced all sorts of uncertainty with this Section 899. Thankfully, that's gone away, so we don't need to worry about that. All right, so now would be the time to get your chats, your questions together, because I'll be moving into talking about next month's presentation. Where can I learn more? If you're interested in figuring out whether we might be an appropriate wealth manager for you, given your cross-border situation, feel free to come to my website. You can also access white papers, blog posts, newsletters. That flowchart, key financial data sheet that I mentioned earlier, I'll be putting up as well. Next month, we'll be talking about estate planning, how to structure your Australian estate to benefit your US beneficiaries. There are things that can be done. There are assets that are better inherited by foreign beneficiaries and other assets better inherited by domestic beneficiaries. We're going to go through that in some detail. I hope you can join me. Now, for those questions, Kay's written in or Gavin's written in. We recently announced our US citizenship. Do we still get taxed on Social Security? Well, let's go back to that. Do you still get taxed on Social Security? So, what was the slide dealing with that? Let's back up. Here we are. No tax on Social Security. Your citizenship has nothing to do with your US tax residency status. That's another point that I should have made. So now that you've transferred from being citizen or permanent resident to citizen, does it change your US tax situation? Not by $1. Not by $1. You would be eligible, assuming your income was within the thresholds mentioned on this slide, for the additional $6,000 or $12,000 deduction for your Social Security. Any other questions, concerns, or doubtful? Astrid, hi, good to see you. Hold on, this guy's
I am Chief of Global
competing with me here. Astrid, thanks, Ashley. Super interested in any future clarifications around remittance tax. Yes. Dev, also good to see you. Will the seminar be available in video form for those that couldn't attend today? Why, that is a question that we address every single time one registers, and the answer is yes. If you've registered, you will be notified that the presentation is up. So that is always the case. If you did miss it, you can go to our website and find it there as well. All right. Well, thank you, everyone. I appreciate your attendance here today. Lots of interest, particularly on the remittance tax. I'm going to make some emails and get some clarity on that. And I look forward to hopefully seeing you all next month. Thanks very much. Have a wonderful day. Oh, good to see you, Jen. I was wondering if you were going to make it. All right. Bye-bye.